Okay, let's talk about the Loonie, which yesterday around this time we were looking at some hotter than expected inflation numbers in Canada, and you briefly saw our Canadian dollar strengthening against the greenback. Overnight, though, the market's been reacting to some commentary from a Fed official in the United States suggesting, hey, maybe interest rates don't just stay elevated in the U.S., maybe they need to go up again. So once again, this story of a weaker Canadian dollar versus a stronger U.S. currency is in play here. Let's bring in Karl Schamotta, Chief Market Strategist of Corpay, who's one of our regular guests and knows all things currency related. Karl, what do you think is going on in the minds of currency traders right now when it comes to the Loonie?
Right, kind of fascinating story going on right now. Basically, the U.S. dollar is a steamroller right now. There's nothing really standing in its path. We have, these extraordinarily hawkish comments from arguably the most hawkish member of the FOMC. That is, helping to lift interest rate differentials in the dollar's favor. But at the same time, we have the Japanese yen falling dramatically. We have the euro under pressure. All of that is leading to a situation in which domestic fundamentals in Canada don't have as much to do with where the Loonie's headed.
Yeah, and I mean, for what it's worth, and take a look at the yen as well. In terms of the interest rate story in Canada, in reaction to the hotter than expected inflation numbers yesterday, we did see some traders pair their expectations for a rate cut by the Bank of Canada in July. I think it's somewhere in the neighborhood of around 30% right now. But you're saying we're welcome to have our big dialogue around what happens next on interest rates in Canada, but you got to look to the United States for the bigger driver on the currency in the short term.
That's right. I think at the end of the day, the dollar is the big story in the world. It is interesting, though, here in Canada, we have seen a dramatic pullback really in odds on that July move. Ahead of the announcement of yesterday's inflation number, we're looking at like roughly 60% odds in favor of a move. And that has been pushed out pretty dramatically. Now it looks as if we are looking at both the Bank of Canada and the Fed moving at a quarterly cadence in the coming 12 to 18 months, cutting at roughly the same pace throughout that period. And so the central bank divergence story has much less to do with what's going on than what we're seeing in broader markets, in particular in the dollar itself.
What does the absolute level of the Canadian dollar mean in terms of the economy in Canada as well? What are you going to be watching on that front?
Well, that's a great question. I think at the end of the day, the level that we're at is quite favorable for the Canadian economy. It does raise some inflation categories. I think that part of what was happening in yesterday's number is that international travel costs went up in the survey month, due partly to a depreciation in the Canadian dollar. But more fundamentally, Canada's export sector is doing very well with this move, right? Canadian exports have become more competitive. We're selling to the world at a cheaper price. And that is arguably more sustainable for Canada than what we have been doing for much of the last couple of decades, which was essentially, borrowing more money, investing it in our homes, and importing goods from the world. So, I do think that this is part of a natural rebalancing process that's great for Canada in the long run.
Okay. The Canadian dollar started the year north of, I want to say, 75 cents. Here we are basically on the doorstep of 73. Given everything you have said, what's your projection for the rest of the year? Where do you think the Loonie ends up trading through the second half of 2024?
Well, the funny part is we're literally sitting on our year-end target right now. This is where we thought we'd be at the end of December this year. So I kind of think that we're setting up for a modest rally in the Canadian dollar, mostly on the basis of potentially more dovish narratives coming from the Fed. So, in contradiction to what we're hearing this morning, I do think that we're going to see continued cooling in the U.S. labor market. Softness in consumer consumption. That's going to lead to a rise in odds on a September rate cut in the U.S., and that should potentially put some downward pressure on the U.S. dollar. So not so much domestic fundamentals driving it, but that sort of broader dollar juggernaut losing a little bit of momentum, that might actually help the Canadian dollar recover a little bit. However, as we've discussed many times, and as most observers really understand at this point, Canada is still deeply vulnerable to a crunch in in the consumption side of the economy due to the rising burden of interest rates on households. So at the end of the day, at the end of the year, we might be sitting very close to where we are, despite a lot of turbulence in between.